Fixed versus variable costs. Analyzing the garage startup. In our previous lesson, we looked at the physical side of John's business, how adding workers to his garage changed the number of keyboards he could produce. Now, we need to translate those workers, parts, and garage space into the language of finance, dollars and cents. To manage a business at an Ivy League level, John must distinguish between different types of costs. Not all expenses are created equal, and understanding the difference between fixed and variable costs is the secret to knowing when a business is truly profitable. In this lesson, we will deconstruct John's expenses to see how they behave as his production scales. According to Gregory Mankiw, some costs stay the same regardless of how much you produce, while others change as you ramp up your operations. Let's start with fixed costs. These are costs that do not vary with the quantity of output produced. For John, the most obvious fixed cost is the rent for his garage. Whether John produces 0 keyboards or 1,000 keyboards in a month, the landlord still expects the same rent check. Other fixed costs might include the specialized 3D printer he bought to make custom cases, the fire insurance for his workshop, or the monthly subscription for his design software. These costs are sunk in the short term. They are present even if the business takes a week off. In the world of corporate finance, fixed costs create what we call operating leverage. If John has very high fixed costs, he needs to sell a lot of keyboards just to break even. But once he covers those costs, each additional sale becomes much more profitable. On the other side of the ledger, we have variable costs. These are costs that change as the firm alters the quantity of output produced. For John, these are the costs of the actual stuff that goes into every keyboard. If he builds 1 keyboard, he needs 1 set of switches, 1 circuit board, and 1 set of keycaps. If he builds 10 keyboards, he needs 10 sets. The wages he pays his part-time assistants are also variable costs. If he decides to double his production and asks his team to work more hours, his labor costs will rise accordingly. Variable costs start at 0 when production is 0 and climb steadily as John gets busier. Understanding these costs is crucial because they determine the minimum price John can charge in the short run to justify staying open. When we add fixed costs and variable costs together, we get total cost. To visualize this, economists look at average total cost, which is simply the total cost divided by the quantity of output. This tells John how much the typical keyboard costs to make. At very low levels of production, John's average total cost is extremely high because the expensive garage rent is being spread over only a few keyboards. However, as John produces more, the average total cost typically starts to fall because he is spreading the overhead. This is the goal of every startup, to reach a volume where the fixed costs become a small fraction of the price of each unit. But remember our last lesson. Diminishing marginal product means that eventually variable costs will start rising so fast that they pull the average total cost back up. This leads us to a fundamental shape in economics, the U-shaped average total cost curve. At the bottom of that U is what Mankiw calls the efficient scale, the quantity of output that minimizes average total cost. For John, finding this point is the holy grail of his business operations. If he produces too little, his rent eats his profits. If he produces too much and his garage becomes a crowded, inefficient mess, his labor costs and waste will eat his profits. As a financial strategist, John's job is to steer the company toward that efficient scale where he's getting the most bang for his buck. By separating fixed and variable costs, John can perform a break-even analysis. He can calculate exactly how many keyboards he needs to sell to cover his rent, and then determine how much profit he makes on every keyboard after that. This is how professional investors analyze companies. They don't just ask, is this company making money? They ask, what is their cost structure? Are they a high fixed cost business like an airline? Or a high variable cost business like a consulting firm? By mastering these concepts, John moves from being a hobbyist in a garage to a sophisticated manager who understands the financial anatomy of his enterprise. He realizes that while he can't change his rent today, he can control his variable costs, and that balance is what will ultimately determine if his startup survives the transition from a garage to a global brand.